Mastering the PRF ETF, Strategies for Professional Investors. In today's dynamic investment landscape, professional investors seek to optimize portfolio performance while mitigating risks across diverse market conditions. The PowerShares FTSE RAFI US 1000 Portfolio ETF, PRF ETF, presents an intriguing opportunity for investors to achieve these objectives through its unique investment approach and strategic positioning. The following delves into key aspects of the PRF ETF, examining its investment objectives, performance metrics, selection criteria, weighting methodology, and risk management strategies to provide professional investors with a comprehensive understanding of its potential value proposition. Question 1. What is the PRF ETF's specific investment objective, and how does it align with current market conditions? The PRF ETF is designed to track the performance of the FTSE RAFI US 1000 index, which comprises the largest U.S. equities selected based on fundamental measures such as book value, cash flow, sales, and dividends. Unlike traditional market capitalization-weighted indices, the PRF ETF employs a fundamentally weighted approach, emphasizing the economic footprint of companies rather than their market price. This strategy aims to capture the true economic value of companies, while mitigating the influence of market sentiment and speculative pricing. In today's market environment characterized by heightened volatility, shifting investor sentiment, and evolving economic fundamentals, the PRF ETF's investment objective offers several advantages. 1. Focus on fundamental factors. Amid market fluctuations, fundamental factors provide a stable foundation for investment decisions. The PRF ETF's emphasis on metrics like book value and cash flow aligns with the fundamental analysis approach favored by many investors seeking long-term value. 2. Risk mitigation. Market volatility often stems from speculative trading, herd behavior, and sudden shifts in sentiment. By weighting holdings based on fundamental measures rather than market capitalization, the PRF ETF inherently reduces exposure to overvalued assets and minimizes the impact of market bubbles. 3. Diversification. The PRF ETF's portfolio comprises a broad spectrum of large-cap U.S. companies spanning various sectors and industries. This diversification shields investors from sector-specific risks and enhances portfolio resilience, particularly during sectoral downturns or economic downturns. 4. Alignment with economic realities. In an era marked by technological disruption, changing consumer preferences, and geopolitical uncertainties, the PRF ETF's focus on economic fundamentals ensures alignment with underlying business performance. This approach enables investors to participate in the growth potential of companies positioned to thrive in the evolving economic landscape. 5. Long-term value creation. By prioritizing companies with robust financial metrics and sustainable business models, the PRF ETF seeks to deliver long-term value appreciation for investors. This aligns with the objectives of many investors seeking to build wealth steadily over time rather than chasing short-term market trends. Question 2. Does the PRF ETF aim to be a core holding for long-term investors or a satellite position for tactical allocation? Before delving into its role within a portfolio, it's essential to grasp the investment approach of the PRF ETF. The PRF ETF tracks the FTSE RAFI US 1000 index, which selects and weights its constituents based on fundamental factors such as book value, cash flow, sales, and dividends. This fundamentally weighted approach differs from traditional market capitalization-weighted indices, aiming to capture the economic footprint of companies while mitigating the influence of market sentiment and speculative pricing. Core holding for long-term investors. 1. Stability and consistency. The PRF ETF's focus on fundamental metrics provides a stable foundation for long-term investment strategies. By prioritizing companies with strong financial fundamentals, the PRF ETF aims to deliver consistent returns over time, making it suitable for investors with a long-term horizon. 2. Diversification benefits. As a core holding, the PRF ETF offers diversification benefits by providing exposure to a broad spectrum of large-cap U.S. companies across various sectors and industries. This diversification reduces portfolio volatility and enhances resilience, aligning with the objectives of long-term investors focused on wealth preservation and steady growth. 3. Passive management. For investors seeking a hands-off approach, the PRF ETF's passive management style offers convenience and cost-effectiveness. By tracking an index, the PRF ETF minimizes portfolio turnover and associated transaction costs, making it an attractive option for long-term investors aiming to maximize returns net of expenses. 4. Alignment with investment goals. Long-term investors often prioritize objectives such as wealth accumulation, retirement planning, and generational wealth transfer. The PRF ETF's investment objective, centered on capturing the true economic value of companies, aligns with these goals by focusing on sustainable growth and value creation over the long term. Satellite position for tactical allocation. 1. Opportunistic exposure. As a satellite position, the PRF ETF can complement core holdings by providing opportunistic exposure to specific market segments or themes. Investors may strategically allocate a portion of their portfolio to the PRF ETF to capitalize on short to medium-term opportunities within the large-cap U.S. equity market. 2. Tactical adjustments. In dynamic market conditions characterized by sector rotation, economic cycles, or geopolitical events, investors may use the PRF ETF as a tactical tool to adjust their portfolio allocation dynamically. By overweighting or underweighting the PRF ETF based on market outlook and investment strategy, investors can enhance portfolio performance and manage risk effectively. 3. Diversification enhancement. While core holdings provide broad diversification, satellite positions like the PRF ETF offer additional diversification benefits by targeting specific factors or investment themes. By incorporating the PRF ETF alongside other ETFs or individual securities, investors can further diversify their portfolio and reduce concentration risk. 4. Active management opportunities. Despite its passive management approach, the PRF ETF's fundamentally weighted methodology allows for active management opportunities within a satellite allocation framework. Investors can capitalize on market inefficiencies, valuation anomalies, or sectoral trends by tactically adjusting their exposure to the PRF ETF based on dynamic market conditions. The role of the PRF ETF within a portfolio depends on investors' investment objectives, risk tolerance, and time horizon. For long-term investors seeking stability, consistency, and diversification, the PRF ETF can serve as a core holding, providing exposure to large-cap U.S. equities with strong fundamental characteristics. Alternatively, for investors looking to enhance portfolio returns, manage risk, or capitalize on short to medium-term opportunities, the PRF ETF can function as a satellite position within a tactical allocation framework. By understanding its investment approach and assessing its suitability within their portfolio construction strategy, investors can effectively leverage the PRF ETF to achieve their financial goals in line with their investment preferences and objectives. Question 3. How does the PRF ETF's investment objective align with different market cycles? The PowerShares FTSE RAFI US 1000 Portfolio ETF, PRF ETF, presents investors with a unique opportunity to navigate various market cycles while pursuing their investment objectives. Understanding how the PRF ETF's investment objective aligns with different market cycles is crucial for optimizing portfolio performance and managing risk effectively. This following explores the dynamic relationship between the PRF ETF's investment approach and prevailing market conditions across different cycles, ranging from expansion to contraction phases. Before delving into the alignment between the PRF ETF's investment objective and market cycles, it's essential to comprehend the different phases of the market cycle. 1. Expansion phase, characterized by economic growth, rising corporate profits, and bullish investor sentiment. The expansion phase is marked by robust equity market performance and increasing risk appetite. 2. Peak phase, as economic indicators peak and momentum slows, the market enters the peak phase, signaling the culmination of the expansionary cycle. Investor optimism remains high, but signs of overheating and potential corrections emerge. 3. Contraction phase, also known as the recessionary phase. The contraction phase is characterized by declining economic activity, contracting corporate earnings, and heightened risk aversion. Equity markets experience downturns, and investor sentiment turns bearish. 4. Trough phase. At the trough of the cycle, economic indicators reach their lowest point, signaling the end of the contraction phase. Equity markets bottom out, presenting opportunities for value investors to enter the market at attractive valuations. The PRF ETF's investment objective is anchored in a fundamentally weighted approach, emphasizing factors such as book value, cash flow, sales, and dividends. This approach offers inherent advantages across different market cycles. Expansion phase. 1. Growth orientation. During the expansion phase, the PRF ETF's focus on fundamental factors aligns with investor preferences for growth-oriented securities. Companies with strong earnings growth, robust cash flows, and expanding market share are favored, driving the PRF ETF's performance. 2. Quality bias. Amidst bullish market conditions, investors prioritize quality and stability. The PRF ETF's emphasis on companies with solid fundamentals and sustainable business models resonates with investors seeking stability and resilience during periods of market exuberance. Peak phase. 1. Risk mitigation. As the market approaches its peak, the PRF ETF's investment objective offers risk mitigation benefits. By prioritizing companies based on fundamental metrics rather than market sentiment, the PRF ETF reduces exposure to overvalued assets and minimizes downside risk during potential market corrections. 2. Diversification. Amidst heightened volatility and uncertainty, the PRF ETF's diversified portfolio provides a cushion against sector-specific risks and market downturns. Investors benefit from exposure to a broad spectrum of large-cap U.S. companies with varying degrees of sensitivity to economic cycles. Contraction phase. 1. Value orientation. During the contraction phase, value-oriented strategies gain prominence as investors seek bargains in a distressed market environment. The PRF ETF's fundamentally weighted approach favors companies trading at attractive valuations, positioning it as an appealing option for value investors looking to capitalize on market dislocations. 2. Dividend yield. In times of economic uncertainty, dividend-paying stocks offer stability and income generation. The PRF ETF's focus on companies with consistent dividends provides investors with a source of passive income, enhancing portfolio resilience amidst dividend cuts and earnings volatility. Trough phase. 1. Opportunistic investing. At the trough of the cycle, investors with a contrarian mindset seek opportunities to capitalize on undervalued assets. The PRF ETF's investment objective aligns with this approach by targeting companies trading below their intrinsic value, offering potential upside as the market rebounds from its lows. 2. Long-term value creation. Beyond short-term market fluctuations, the PRF ETF's focus on companies with strong fundamentals and sustainable growth prospects positions investors for long-term value creation. By remaining disciplined and patient during the trough phase, investors can benefit from the eventual recovery and resurgence of the market. The PRF ETF's investment objective is well aligned with different market cycles, offering investors a strategic approach to navigate through various phases of economic expansion and contraction. Whether in periods of growth, peak, contraction, or trough, the PRF ETF's fundamentally weighted methodology provides investors with stability, diversification, and potential for long-term value creation. By understanding how the PRF ETF's investment approach intersects with prevailing market conditions, investors can effectively incorporate it into their portfolio strategy to achieve their investment objectives while managing risk across different market cycles. Question 4. What is the primary source of alpha generation for the PRF ETF? At the core of the PRF ETF's alpha generation is its fundamentally weighted methodology, which diverges from traditional market capitalization weighted indices. Instead of weighting securities based on market capitalization, the PRF ETF selects and weights its holdings based on fundamental factors such as book value, cash flow, sales, and dividends. This approach aims to capture the true economic value of companies, while mitigating the influence of market sentiment and speculative pricing. Key sources of alpha generation in the PRF ETF. 1. Value investing principles. The PRF ETF's emphasis on fundamental factors aligns with value investing principles, which prioritize the purchase of undervalued securities with strong underlying fundamentals. By targeting companies trading at discounts to their intrinsic value, the PRF ETF positions itself to benefit from potential revaluations as market inefficiencies are corrected. 2. Contrarian opportunities. The fundamentally weighted methodology of the PRF ETF allows it to capitalize on contrarian opportunities within the market. During periods of market exuberance or pessimism, the PRF ETF may overweight or underweight certain sectors or securities based on their fundamental attractiveness relative to market prices, potentially generating alpha by exploiting mispricings. 3. Quality bias. The PRF ETF's focus on fundamental metrics such as profitability, cash flow, and dividend sustainability introduces a quality bias into its portfolio construction. By prioritizing companies with solid financial health and sustainable business models, the PRF ETF seeks to reduce downside risk and enhance long-term returns, potentially generating alpha through superior risk-adjusted performance. 4. Diversification benefits. Diversification is a cornerstone of alpha generation in the PRF ETF. Its portfolio comprises a broad spectrum of large-cap U.S. companies across various sectors and industries, reducing concentration risk and enhancing portfolio resilience. By avoiding overexposure to any single security or sector, the PRF ETF minimizes idiosyncratic risk and potentially enhances alpha generation over the long term. 5. Active management opportunities. While the PRF ETF adopts a passive management approach in tracking its index, it provides active management opportunities within its fundamentally weighted framework. Portfolio rebalancing, sector rotation, and tactical adjustments based on changing market dynamics allow the PRF ETF to adapt to evolving investment opportunities and potential sources of alpha generation. The PRF ETF's alpha generation stems from its fundamentally weighted methodology, which emphasizes value investing principles, contrarian opportunities, quality bias, diversification benefits, and active management opportunities. By targeting companies with strong underlying fundamentals, mitigating downside risk, and exploiting mispricings in the market, the PRF ETF positions itself to deliver alpha consistently over the long term. Investors seeking to capitalize on alpha generation in their portfolios may consider the PRF ETF as a strategic component to enhance returns and manage risk effectively in diverse market environments. Question 5. What criteria are used to select companies for inclusion in the PRF index, and how often are these criteria reviewed? The PRF index adopts a fundamentally weighted methodology, departing from traditional market capitalization weighted indices. The selection criteria used to determine inclusion in the PRF index prioritize fundamental factors such as book value, cash flow, sales, and dividends, aiming to capture the true economic value of companies while minimizing the influence of market sentiment and speculative pricing. The following criteria are key components of the PRF index's selection process. 1. Book value. Book value, also known as shareholder equity, represents the net asset value of a company's assets minus its liabilities. Companies with higher book values are favored for inclusion in the PRF index, reflecting their strong asset base and potential for long-term value creation. 2. Cash flow. Cash flow measures the net amount of cash generated or expended by a company's operations, investing activities, and financing activities. Companies with robust cash flows are preferred for inclusion in the PRF index, as they demonstrate financial strength and resilience. 3. Sales. Sales, or revenue, represents the total amount of money generated by a company from its core business operations. Companies with higher sales figures are considered for inclusion in the PRF index, indicating their market presence and revenue-generating capabilities. 4. Dividends. Dividends represent the portion of a company's earnings distributed to its shareholders as a reward for their investment. Companies with consistent dividend payments and sustainable dividend yields are prioritized for inclusion in the PRF index, reflecting their shareholder-friendly policies and financial stability. The criteria used to select companies for inclusion in the PRF index are reviewed periodically to ensure alignment with changing market dynamics and economic conditions. The frequency of review may vary based on factors such as index methodology, market volatility, and regulatory requirements. Typically, the criteria review process encompasses the following aspects. 1. Regular rebalancing. The PRF index undergoes regular rebalancing to adjust its constituent holdings and weights in response to changes in market conditions. Rebalancing intervals may vary but are often conducted on a quarterly or semi-annual basis to maintain alignment with the index's investment objectives. 2. Index committee oversight. An index committee, comprised of industry experts and financial professionals, oversees the criteria review process for the PRF index. The committee monitors market developments, evaluates company performance, and assesses adherence to selection criteria to ensure the integrity and relevance of the index. 3. Methodology enhancements. Periodically, the methodology of the PRF index may be enhanced or refined to incorporate new insights, industry best practices, or regulatory changes. Methodology enhancements are subject to thorough review and may involve consultation with market participants and stakeholders. The selection criteria used to determine inclusion in the PRF index prioritize fundamental factors such as book value, cash flow, sales, and dividends, reflecting the index's focus on capturing the true economic value of companies. The frequency of criteria review ensures that the PRF index remains relevant, transparent, and reflective of evolving market dynamics. Investors can rely on the PRF index as a benchmark for evaluating the performance of the PRF ETF and gaining exposure to a diversified portfolio of large-cap U.S. companies selected based on rigorous fundamental criteria. Question 6. What is the rationale behind the weighting methodology used in the PRF ETF? Unlike traditional market capitalization weighted indices, which assign weights to constituent securities based on their market capitalization, i.e., the total market value of their outstanding shares, the PRF ETF employs a fundamentally weighted approach. This methodology prioritizes fundamental factors such as book value, cash flow, sales, and dividends, aiming to capture the true economic value of companies while mitigating the influence of market sentiment and speculative pricing. Rationale behind the fundamentally weighted methodology. 1. Focus on economic footprint. The rationale behind the fundamentally weighted methodology of the PRF ETF lies in its emphasis on the economic footprint of companies. By prioritizing fundamental factors such as book value, cash flow, sales, and dividends, the PRF ETF aims to identify companies with strong underlying fundamentals and sustainable business models, irrespective of their market capitalization. 2. Mitigation of market sentiment. Market capitalization-weighted indices are susceptible to the influence of market sentiment and speculative pricing, as they assign higher weights to companies with larger market capitalizations, regardless of their underlying fundamentals. In contrast, the fundamentally weighted methodology of the PRF ETF mitigates the impact of market sentiment by focusing on objective measures of economic value. 3. Enhancement of diversification. By weighting constituent securities based on fundamental factors, the PRF ETF enhances portfolio diversification and reduces concentration risk. Market capitalization-weighted indices tend to be heavily concentrated in a few large-cap stocks, leading to increased volatility and exposure to idiosyncratic risk. The fundamentally weighted methodology of the PRF ETF promotes a more balanced allocation across companies and sectors, thereby improving diversification. 4. Alignment with value investing principles. The fundamentally weighted methodology of the PRF ETF aligns with value investing principles, which prioritize the purchase of undervalued securities with strong underlying fundamentals. By targeting companies trading at discounts to their intrinsic value, the PRF ETF seeks to capitalize on opportunities for long-term value creation and potential outperformance relative to market capitalization-weighted indices. 5. Long-term performance potential. Proponents of fundamentally weighted indices argue that they offer potential for long-term outperformance compared to market capitalization-weighted indices. By focusing on companies with strong financial metrics and sustainable business models, the PRF ETF aims to deliver competitive returns over the long term, driven by factors such as earnings growth, dividend income, and capital appreciation. The fundamentally weighted methodology of the PRF ETF is rooted in its focus on capturing the true economic value of companies while minimizing the influence of market sentiment and speculative pricing. By prioritizing fundamental factors such as book value, cash flow, sales, and dividends, the PRF ETF aims to enhance portfolio diversification, mitigate concentration risk, and align with value investing principles. Investors seeking exposure to a diversified portfolio of large-cap U.S. companies selected based on rigorous fundamental criteria may find the PRF ETF to be a compelling option within their investment strategy. Question 7. How does the PRF ETF achieve diversification across different asset classes, sectors, and risk factors? Diversification is a cornerstone of sound investment strategy, aimed at reducing risk and enhancing returns by spreading investments across different asset classes, sectors, and risk factors. The PowerShares FTSE RAFI US 1000 Portfolio ETF, PRF ETF, offers investors a unique opportunity to achieve diversification within their portfolios. This following explores how the PRF ETF achieves diversification across various asset classes, sectors, and risk factors, providing investors with insights into its strategic approach and potential benefits. Diversification across asset classes. 1. Equities. As an equity-focused ETF, the PRF ETF primarily invests in a diversified portfolio of large-cap U.S. stocks. By selecting companies from the FTSE RAFI US 1000 index based on fundamental factors such as book value, cash flow, sales, and dividends, the PRF ETF achieves diversification within the equity asset class, spreading investments across different companies and industries. 2. Fixed income. While the PRF ETF is predominantly equity-oriented, it may indirectly provide exposure to fixed income securities through the inclusion of dividend-paying stocks with stable cash flows and consistent dividend yields. These dividend payments can serve as a source of income for investors, complementing the equity component of the portfolio and enhancing overall diversification. Diversification across sectors. 1. Technology. The PRF ETF diversifies across various sectors, including technology, by selecting companies from the FTSE RAFI US 1000 index representing different industries. While technology stocks may constitute a significant portion of the portfolio given their prominence in the U.S. equity market, the PRF ETF maintains exposure to other sectors such as healthcare, consumer goods, financials, and industrials, ensuring sectoral diversification. 2. Healthcare. Healthcare stocks are another key component of the PRF ETF's diversified portfolio, offering exposure to companies engaged in pharmaceuticals, biotechnology, healthcare services, and medical equipment. By including healthcare stocks alongside other sectors, the PRF ETF spreads risk and captures growth opportunities across different segments of the economy. 3. Consumer goods. Consumer goods companies, encompassing sectors such as retail, food and beverage, and household products, contribute to the diversification of the PRF ETF's portfolio. These companies serve as proxies for consumer spending trends and economic activity, providing investors with exposure to resilient and defensive sectors. Diversification across risk factors. 1. Market capitalization. The PRF ETF's fundamentally weighted methodology ensures diversification across market capitalization categories by selecting companies based on fundamental factors rather than market capitalization alone. This approach reduces concentration risk inherent in traditional market capitalization-weighted indices and provides exposure to a broad spectrum of large-cap U.S. stocks. 2. Factor exposure. Factor-based investing is integral to the PRF ETF's diversification strategy, with a focus on factors such as value, size, profitability, and low volatility. By incorporating companies exhibiting these factor characteristics, the PRF ETF enhances diversification and potentially captures risk premiums associated with each factor. 3. Geographic exposure. While the PRF ETF primarily focuses on U.S. equities, it indirectly achieves geographic diversification through exposure to multinational corporations with global operations. These companies derive revenue from diverse geographic regions, reducing dependency on any single market and enhancing portfolio resilience. The PRF ETF employs a strategic approach to achieve diversification across different asset classes, sectors, and risk factors. By investing in a diversified portfolio of large-cap U.S. stocks selected based on fundamental criteria, the PRF ETF spreads risk and captures growth opportunities across various segments of the economy. Investors seeking to enhance portfolio diversification and mitigate risk may consider incorporating the PRF ETF into their investment strategy, benefiting from its broad exposure to different asset classes, sectors, and risk factors within a single investment vehicle. Question 8. How is the PRF ETF positioned for the current market environment, considering key economic and geopolitical factors? In today's dynamic market environment, Investors face a myriad of economic and geopolitical factors that influence asset prices and investment decisions. The PowerShares FTSE RAFI US 1000 Portfolio ETF, PRF ETF, is strategically positioned to navigate these complexities, offering investors exposure to a diversified portfolio of large-cap U.S. stocks selected based on fundamental criteria. The following examines how the PRF ETF is positioned for the current market landscape, considering key economic and geopolitical factors shaping investment opportunities and risks. Assessment of key economic factors. 1. Economic growth. The PRF ETF is positioned to capitalize on economic growth trends, with holdings selected based on fundamental factors such as book value, cash flow, sales, and dividends. As the U.S. economy continues to recover from the impacts of the COVID-19 pandemic, the PRF ETF may benefit from increased consumer spending, corporate earnings growth, and business investment. 2. Inflation outlook. Inflationary pressures have emerged as a key concern for investors, driven by factors such as supply chain disruptions, rising commodity prices, and fiscal stimulus measures. The PRF ETF's fundamentally weighted methodology may provide a hedge against inflation, as companies with strong financial fundamentals and pricing power are better positioned to weather inflationary environments. 3. Interest rates. The PRF ETF's positioning in the current market environment takes into account the trajectory of interest rates and monetary policy actions by central banks. As interest rates remain low and central banks maintain accommodative policies to support economic recovery, the PRF ETF may continue to benefit from favorable borrowing conditions and corporate profitability. Assessment of key geopolitical factors. 1. Trade relations. Geopolitical tensions and trade disputes between major economies, such as the U.S. and China, can impact global supply chains, corporate earnings, and market sentiment. The PRF ETF's diversified portfolio of large-cap U.S. stocks reduces exposure to geopolitical risks associated with international trade, focusing instead on domestic companies with established market positions. 2. Geopolitical risks. Heightened geopolitical risks, including geopolitical conflicts, terrorism, and geopolitical instability, can disrupt financial markets and investor confidence. The PRF ETF's positioning takes into account geopolitical risks by diversifying across sectors and industries, minimizing concentration risk and enhancing portfolio resilience. 3. Regulatory environment. Changes in regulatory policies, including tax reforms, antitrust measures, and industry-specific regulations, can impact the performance of individual stocks and sectors. The PRF ETF's investment approach considers regulatory risks by selecting companies with strong governance practices, regulatory compliance, and adaptability to changing regulatory environments. Strategic considerations for the PRF ETF. 1. Long-term value creation. The PRF ETF is positioned for long-term value creation, emphasizing companies with sustainable business models, competitive advantages, and growth potential. By focusing on fundamental factors, the PRF ETF seeks to deliver competitive returns over the long term, irrespective of short-term market fluctuations. 2. Risk management. Risk management is integral to the PRF ETF's positioning in the current market environment, with a focus on mitigating downside risk and preserving capital. Diversification, fundamental analysis, and active risk monitoring are key components of the PRF ETF's risk management strategy, aimed at enhancing portfolio resilience and minimizing volatility. 3. Opportunistic investing. The PRF ETF is positioned to capitalize on opportunistic investment opportunities arising from market dislocations, sector rotations, and mispricings, By maintaining flexibility and adaptability in portfolio construction, the PRF ETF can seize opportunities for alpha generation and outperformance relative to market benchmarks. The PRF ETF is strategically positioned for the current market environment, considering key economic and geopolitical factors shaping investment opportunities and risks. With a focus on fundamental criteria, diversification, and risk management, the PRF ETF offers investors exposure to a diversified portfolio of large-cap U.S. stocks, positioned for long-term value creation and resilience in dynamic market conditions. As investors navigate economic uncertainties and geopolitical risks, the PRF ETF serves as a strategic component of diversified investment portfolios, offering potential for growth and capital preservation in an ever-changing market landscape. Question 9. What are the potential future opportunities for the PRF ETF's investment strategy? The PowerShares FTSE RAFI US 1000 Portfolio ETF, PRF ETF, stands at the forefront of innovation, offering a fundamentally weighted investment strategy that aligns with long-term value creation. The following delves into potential future opportunities for the PRF ETF's investment strategy, exploring emerging trends, market dynamics, and areas of growth that could drive performance and enhance investor outcomes. 1. Expansion of ESG integration. Environmental, social, and governance (ESG) considerations have gained prominence among investors seeking sustainable and responsible investment opportunities. The PRF ETF may explore opportunities to integrate ESG factors into its investment strategy, aligning with investor preferences and addressing evolving societal and environmental challenges. 2. Innovation and technological advancements. Technological innovation continues to disrupt traditional industries and create new investment opportunities across sectors such as artificial intelligence, renewable energy, and digital transformation. The PRF ETF may capitalize on these trends by identifying companies at the forefront of innovation and technology adoption, driving growth and value creation for investors. 3. Global market expansion. With increasing globalization and interconnectedness, opportunities for global market expansion abound. The PRF ETF may explore opportunities to expand its investment universe beyond U.S. equities, providing investors with exposure to international markets and diversification benefits across geographic regions and sectors. 4. Sector rotation and tactical asset allocation. Sector rotation and tactical asset allocation present opportunities for the PRF ETF to enhance portfolio returns and manage risk dynamically. By monitoring sectoral trends, economic indicators, and market dynamics, the PRF ETF can adjust its sectoral allocations and tactical positioning to capitalize on emerging opportunities and mitigate downside risks. 5. Income generation and dividend growth. In an environment of low interest rates and yield compression, income generation and dividend growth become increasingly attractive for investors seeking stable returns and passive income. The PRF ETF may focus on companies with consistent dividend payments, strong cash flows, and dividend growth potential, providing investors with an alternative source of income and enhancing total return potential. 6. Value investing resurgence. Despite periods of market volatility and uncertainty, value investing principles remain relevant for investors seeking bargains and undervalued opportunities. The PRF ETF's fundamentally weighted methodology aligns with value investing principles, emphasizing companies trading at discounts to their intrinsic value and poised for long-term value creation. 7. Factor-based investing strategies. Factor-based investing strategies, such as value, size, profitability, and low volatility, offer opportunities for alpha generation and risk diversification. The PRF ETF may explore factor-based approaches to enhance portfolio returns and manage risk efficiently, leveraging factors that exhibit persistence and robustness across market cycles. The PRF ETF's investment strategy is poised to capitalize on a diverse array of future opportunities, ranging from ESG integration and technological innovation to global market expansion and income generation. By remaining adaptable, innovative, and responsive to emerging trends and market dynamics, the PRF ETF can continue to deliver value to investors and serve as a strategic component of diversified investment portfolios. As investors navigate an increasingly complex and dynamic investment landscape, the PRF ETF stands ready to unlock future opportunities for portfolio growth, diversification, and long-term wealth creation. Question 10. What risk management strategies does the PRF ETF employ to mitigate downside risk? Before delving into risk management strategies, it's important to understand downside risk and its implications for investors. Downside risk refers to the potential for investments to incur losses or underperform relative to expectations, particularly during adverse market conditions or downturns. Mitigating downside risk is critical for protecting investor capital and minimizing portfolio volatility, enhancing the probability of achieving long-term investment goals. Risk management strategies employed by the PRF ETF. 1. Diversification. Diversification is a fundamental risk management strategy employed by the PRF ETF to mitigate downside risk. By investing in a diversified portfolio of large-cap U.S. stocks selected based on fundamental criteria, the PRF ETF spreads risk across different companies, sectors, and industries, reducing concentration risk and enhancing portfolio resilience. 2. Fundamentally weighted methodology. The PRF ETF's fundamentally weighted methodology serves as a risk management tool by prioritizing companies with strong financial fundamentals and sustainable business models. By selecting companies based on factors such as book value, cash flow, sales, and dividends, the PRF ETF aims to mitigate downside risk associated with overvalued or financially distressed companies. 3. Active risk monitoring. Active risk monitoring is integral to the risk management process of the PRF ETF, enabling portfolio managers to identify and respond to potential sources of downside risk in a timely manner. By monitoring key risk indicators, market trends, and macroeconomic developments, the PRF ETF can adjust its portfolio positioning and asset allocation to mitigate emerging risks. 4. Sector rotation. Sector rotation is a tactical risk management strategy employed by the PRF ETF to capitalize on sectoral trends and mitigate sector-specific risks. By dynamically adjusting sectoral allocations based on changing market conditions and economic outlook, the PRF ETF seeks to minimize exposure to underperforming sectors and enhance portfolio returns. 5. Factor-based investing. Factor-based investing strategies, such as value, size, profitability, and low volatility, are employed by the PRF ETF to mitigate downside risk and enhance risk-adjusted returns. By targeting factors that exhibit persistence and robustness across market cycles, the PRF ETF diversifies risk and reduces vulnerability to market downturns. 6. Portfolio rebalancing. Portfolio rebalancing is a systematic risk management strategy employed by the PRF ETF to maintain target asset allocations and manage portfolio risk. By periodically rebalancing the portfolio to align with strategic objectives and risk tolerance, the PRF ETF ensures disciplined portfolio management and minimizes the impact of market fluctuations on portfolio performance. The PRF ETF employs a comprehensive array of risk management strategies to mitigate downside risk and preserve investor capital in dynamic market conditions. From diversification and fundamentally weighted methodology to active risk monitoring and sector rotation, each strategy plays a crucial role in enhancing portfolio resilience and achieving long-term investment objectives. As investors navigate an increasingly complex and uncertain investment landscape, the PRF ETF stands ready to deliver risk-adjusted returns and provide investors with peace of mind in achieving their financial goals. As professional investors navigate the complexities of the financial markets, the PowerShares FTSE RAFI US 1000 Portfolio ETF, PRF ETF, emerges as a strategic tool for achieving investment objectives in diverse market conditions. From its specific investment objectives aligned with current market dynamics to its performance comparison with benchmarks and peers, the PRF ETF offers investors a well-rounded approach to portfolio optimization. With its focus on alpha generation, rigorous selection criteria, innovative weighting methodology, and proactive risk management strategies, the PRF ETF is positioned to capitalize on future opportunities and navigate potential challenges, making it a compelling choice for professional investors seeking long-term value creation and risk mitigation in their investment portfolios.